Hello and welcome again. This is Islam Ahmad. I will be your lecturer today. Please confirm if you can see my screen and hear my voice. I will transfer the screen now to the risk warning. So please confirm if you can see my screen that has the risk warning written in both English and Arabic. If you have any issue or you can't see the screen, please send me a message on the chat. Right, everything looks to be working fine. Now we will start by taking a minute to read the risk warning. The risk warning states that trading in Forex, CFD and other derivatives is highly speculative and carries a high level of risk. It's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Okay, please review the risk warning. If you are Arabic speaker, there is also a translated version. This lecture will be uploaded on the website and on our channel on YouTube, so you can take your time to read the risk warning if you haven't a chance to read it now. Okay, let's move on to our subject today. Today we will speak about a very big subject, and this is the trading plan, how to craft your ultimate trading plan. This is the most important topic of this month. This can be, you can say it's the sum of the topics we were speaking about. We were speaking about risk management and money management, and also a lot of trading concepts. Today, we will try to collect all this in one trading plan, and you should always have a trading plan. There is an old saying that say if you fail to plan, then you plan to fail. Okay, so it takes time and effort to and a lot of research to develop approach or methodology that works in financial markets. There is never any guarantees of success. Okay, there will always be a risk, and there will always be a chance that you make some losses, but you have eliminated one major roadblock by creating a detailed trading plan. So there is some key points you should think about before we start, that having a plan is essential for achieving trading success. So there is no plan, there is no trading success. Another thing is a trading plan should be written in stone, but it's subject to re-evaluation and can be adjusted along with the changing market conditions, meaning that follow, but you have a plan and you have written and you have decided. It's subject to re-evaluation. You can readjust the plan if you have any issue. Okay, at any moment, if you have any issues with the voice or the screen, just please send me on the chat. Now let's move on. The key point is a solid trading plan consider a trader's personal style and goals. This means that it's not only one way to do it. We are different, so anyone can make a plan that suits him better. So a solid trading plan, as we said, consider this trading personal style and goals. Also, knowing when to exit a trade is just as important as knowing when to enter the position, because a lot of times we fail in this trap that we think a lot of when to enter, how to enter the trade, what's the perfect condition, what's the perfect entry point. Then after we enter the trade, we don't have a clue of exit the trade, how we will exit the trade. So before you start your trading plan, you have to know that when to exit a trade is just as important as knowing when to enter the trade. Also, stop loss prices and profit targets should be added to the trading plan to identify specific exit points for each trade. We will speak about this further in our conversation today, and also at the end of this lecture, we will have some practical lessons on the live market. So let's move on. We don't need to explain more on these key points because we will return to it. So building the perfect trading plan should start with this base statement that no two trading plans are the same, okay? Because no two traders are exactly alike. Each approach reflects the important factors like trading style as well as risk tolerance. So what are the other essential components of solid trading plan? Today we will speak about 10 components that every trading plan should include. Let's move on and go with the number one. The number one and the most basic and important thing should have on your trading plan is goal definition. Okay, you need to firstly define your goal. If you are new to trading, you should determine financial objective, risk tolerance, and time horizon. These items need to be clearly articulated to ensure that your trading activities can be achieved. This is the first thing in your trading plan, goal definition. Okay, let's have some example on this. If I'm trying to make my trading plan right now, I would say this is an example, okay? This is not exact numbers. I want to make 24% return in my capital, my initial capital, in 1 year, and I'm willing only to risk 10% of that capital in the process. Okay, this time frame and percentage can change from one trader to another and from trading style to another. I'm just trying to give you an example so you can make your own. Okay, you can change this 24% to 10%. Okay, you can change the 10% risk to 5% or 2%. You can even increase the number. I don't encourage you to do so, to increase your risk numbers, but you can do this. This is your own trading plan, but you need to have something. You need to have a goal, a written goal. And as you see here, I did it in a 1 year time frame, 1 year horizon. You can make it like 5 years. You can even make it for 1 month. It's dependent totally on you. But you have to have this defined goal. This is the first thing you need in your trading plan. So the second thing you need in your trading plan is trading style selection. So a trading style need to be identified. This style should reflect your personality, your culture, your preferences. The plan can include day trading, for example, day trading or swing trading or position trading. If you are new to this terms, it simply means short or long-term investment. Okay, so you have to choose a style that align with your goals and your time availability. Let's have an example on this. For example, if you can see my screen, I just want to take a moment to make sure that everyone here can see my screen. Okay, looks like everything is working fine. Great. So here you can see this is an example of this is the gold daily chart. Okay, you can choose to trade on gold in a daily basis or in a scalping position. You can choose to stay for days or you can stay for even minutes. Okay, for example, this chart, the same chart you can see right now, which is daily, you can make analysis on it if it's just 1 minute chart, as we will see in further charts in this lecture. So you just now, for this example, you can have your position for some days. Okay, if you have this mentality, if you have this style, you have chosen this before you start your trading, then you will use this kind of chart. If you trying to do scalping, you will use 1 minute chart. Okay, this is an example and you can do your own. Let's move on. So now after this two steps or two stones in your wall, in your plan, your trading plan, you need to have strategy. Okay, maybe for most of us, this is the most important part. For most of us, we focus on this and it's very important. Okay, but also you need to focus on other aspects I'm talking about. So regarding the strategy development, you need a detailed strategy, and this detailed strategy needs to be created, outline the approach to the market. You have to have a criteria for trade selection, and you need to be defined. This include like, are you going to use technical indicators, or are you going to use fundamental analysis, or maybe you can combine both. Some people do so. Me personally, I prefer to do the combination of both. So finally, when you are building this strategy, you have to have the entry and exit tactics. You have to make your risk management. You already have a lecture dedicated to this concept of risk management techniques. You have to have the position sizing. We also speak about money management and how to size your position. This is very important. So the strategy have to have all these aspects defined before you enter the market, before even you approach how I'm going to approach. Okay, so let's move on to an example for this example. You can see here, this is the euro dollar chart. You can use like, if you can see here, this below part of the screen, this is the RSI, okay? And here there is the Bollinger Bands, okay? We can use, this is like a very simple strategy, but it's effective, okay? You can use the RSI and Bollinger Bands to define a reversal areas or zones to enter a trade, okay? This is, okay, a strategy right now. I can decide when to enter the market based on this strategy and how much risk I'm going to take, like 1% per trade, how much risk I'm going to take overall, as we will speak later in the coming points. Before this, the fourth step in your trading plan is to set realistic expectation, okay? Trading is not guaranteed path to wealth, okay? It's involving risk. So you have to have this realistic expectation for return. You have to set the potential for loss. You have to recognize that you might lose. You should avoid the trap of chasing quick profits or risking too much capital on a single position or trade, okay? Because this is a common mistake. So for example, let's say I will set 24% as expected profit per year, okay? This is the same example. Let's continue with it. So this means I need to make 2% profit each month, okay? Does this mean I guarantee to make 2% every month? No, this is not guaranteed. Maybe in 1 month I can make 5% more than my targets, and maybe in another month I can make 2% lose. But you see, if I have this 5% profit and 2% loss, these 2 months combined will make almost 2.5% of profit. So you got my point? You should always keep your risk within reason, within the range you have set, okay? So keep your realistic expectation when you make your trading plan. Sometimes people give I want to make 1000%. Opening an account with like 1000, I want to make this a million. Okay, I'm not trying to break your dreams, but just be realistic. Let's move on to point number 5. You have to have comprehensive market analysis. You need to conduct through market analysis to identify the potential trade opportunities. If they are part of your plan, analyze chart, okay? If you are using technical analysis, okay, you have to do this. Market trend should be studied. You have to be aware of news and economic indicators. You must monitor everything that's happening in the market. If you are following our channel, we always talk about this. We have this calendar on our website. So you have to always monitor what's happening in the market. You have to take a step back and consider the overall market conditions. So let's have this example. For example, this chart was from the day before yesterday. This is the USD versus CAD, the dollar, the American US dollar versus the Canadian dollar. This is 1 hour chart. And this is before the Bank of Canada interest rate announcement. Okay, the market expected the bank to decrease the interest to 4.5%. This weakening the CAD. You should know this before you enter a trade. If you look to this uptrend, this is before the announcement. We already didn't get the news yet, but the market reacted before this. So you have this uptrend. The United States dollar is more stronger than the Canadian dollar because of the decrease of the interest rate. We will speak more about this calendar and interest rates maybe in future lectures. But you have to know that, for example, you can look at this chart and see maybe there is a reversal opportunity. No, you have this very important news coming, and you shouldn't go against the trend in this fundamental times. So technical analysis is very important. I like it myself. I use it a lot, but you need fundamental backup, as we saw in this example. And if, matter of fact, actually, the Bank of Canada announced 4.5% as market expected, and this affected more the pair of USD CAD, and actually it's moving more than what you can see in this chart. It's actually moved more in the upside. So if you were trying to get this reversal, you will not get it because of this fundamental fact. You see what I mean? When there is a fundamental fact, the chart cannot act against it. Sometimes it does, but it's not logical to do or to wait for this rare chance. Let's move on. So number 6 in your trading plan, you have to have risk management rule development. Okay, as I mentioned, we speak about risk management in a dedicated lecture. We will speak about it again and again at every webinar. If you are following, we always have this risk warning at the beginning, because you always have to manage your risk. In any business you make, you have to manage your risk. And especially in Forex trading, you have to manage your risk to protect your capital. Risk management strategies should be applied and should be implemented to allocate a percentage of your portfolio to each trade, and don't go above the amount you have determined. I always say that 1% is enough. Okay, if you are risky, you can make it like 2%, but not more than this in each trade. Even if you have more than this, okay, this is my strategy. But if your strategy is risky, you have to define how much risk. Even it's 5% or 10% or even more, you have to define this in your trading plan before you enter the market. And this amount should be equivalent to the amount that you are willing to lose per trade. Okay, you have to use a stop loss order to limit potential loss and establish clear take profit targets to secure gains. Okay, this is very important. We have spoken about the emotional trading, how fear and greed can make you stop or even make a rational decision. So you shouldn't. Before entering the trade, you should determine how much risk are you going to take. You have to set a percentage for each trade. You have to set this in your trading plan. Actually, you should write it in your trading plan, and before any trade, you should never exceed this limit. So keep your risk management. So this is an example. Okay, you see this table. So you can decide not to risk more than, like as I told you. Let's take a moment in this chart. I have already explained, but just let's take a moment. You can decide not to risk more than 1% of your account. Okay, in one trade, 1%. So also you can make an overall account risk like 5%. All my trades will not exceed the risk of 5%. Also, you can set monthly risk of like 10%. I'm giving you example right now. You can have 20% risk of account. Okay, see this table? I have risk per trade. This is 1%. This is my number, 1%. You can change this number, but you have to have this table: risk per trade, risk on total trades. Here you can see it's 5%. Risk on a monthly basis. Here you can see it's 10%. Risk on the total account. Here you can see it's 20%. In my plan, you can see at the end that I've written to myself, you must decide before starting, and if you reach this level, you have to stop your trading. Okay, you can change your number. Here there is an example of $5,000 account, so the risk per trade would be $50. The risk per total trades would be $250, and the monthly risk would be $500, and the yearly risk would be $1,000, which equal 20% risk of this account. Okay, if you have $100,000 account, if you have 1 million account, if you have $200 account, no matter how big or small your account, you have to apply the same principles. You can change the numbers, but the percentage have to be determined before you enter the trade. This is very important. This is very important. You have to have this table in your trading plan. Let's move on to the trade management plan. So you have to determine how you will manage your open position. I want you to remember that I'm speaking now about planning your trade before you enter the market. So before you enter the market, you have to decide how you will deal with your open position, how you will manage them. You should determine when to adjust stop loss order. So if you set a stop loss and take profit order, are you going to leave them so the trade will hit either stop loss or take profit, or are you going to use like trailing stop? I will explain more the concept of trailing stop in the live trading exam. So whatever your methodology is, you have to decide before entering the market, before even analyzing the market, how you are going to exit the market. You have to have a trade management plan. How are you going to manage your trade? Okay. Let's have this example. This is a dollar yen 1 minute chart. Okay, let me use this pen. So, for example, you can see this area here. Maybe you are going to wait for a break. Okay, here the break happened, and you can enter the trade. Okay, for example, the stop loss should be here above this level, and let's say you can have your target in this area because this is the previous support level here. Okay, so what are you going to do while this is happening? See this big candle? Are you going to trail your stop? Are you going to wait? Are you going to leave it like this? How you will handle? You have to decide this before entering the market. There's no right or wrong. Okay, maybe I prefer something, you prefer something else. I will speak more about this in the live trading example, but you have determined before trading, before entering the market, how you will manage your open positions. Let's move on to the 8th point of your trading plan. You have to have trading discipline maintenance. Out of all the points I spoke about and I will speak about, this is the most common mistake that traders in Forex market do: lack of discipline. So please don't do this. Once you have written your trading plan down, stick with it. Avoid situation where you abandon your trading plan impulsively because the market is doing something, or there's some emotional response you feel. This is fear or greed. Okay, train yourself to embrace discipline and consistency. So when executing or exiting the trade, you have to have the discipline, as we spoke about. There is entry point, there is exit point, and there is discipline to maintain this. So point number 9 in your trading plan: a detailed record. You have to monitor and make trade evolution. A detailed record of trading activity include entry and exit point, reasons for taking the trade, and the outcomes. This is essential. A frequent review and evaluation of trades is necessary to becoming a good trader. Okay, so you make some trades, good trades, and losing trades, it's fine. You have to have evaluation. You have to review the past trades. This will allow you to identify patterns, strengths point, and also improve your weakness point. Okay, So the time is just, chasing us. Let's go to point number 10. The last point in your trading plan is continuous education. You have to stay updated on market trends, economic news, new trading techniques. You have to read books, you attend seminars and webinars just like this one. We have online webinar each Thursday, the same time, 6 p.m. Dubai time. Please always be with us and attend even other seminars if you like. It's fine. Seminars, webinars. You have to find financial news sources. You have to interact with experienced trader to enhance your knowledge and your skills in trading. You have to continue educating yourself in this market. So this is the 10 points or key points, should I say, in your trading plan. If you have any question, feel free to send it to me right now in the chat while I will wait. Let's not waste time. Let's go to the live market. Okay, please make sure that you can see my screen. Tell me if there is anything, there is an issue. Okay, I think everybody now can see my screen. Okay. Let's have this example on gold. Let's go with gold. Okay, as we mentioned before, I will not have time to go through all the points of the trading plan, but let's do it like very fast. If I'm having a trading strategy of risking only like 1% per trade, and this is almost $5,000 account, and let's say I'm trading on gold, and my goal or my strategy will be long term, not scalping or not short term. So now I'm trying to analyze the market. Let's say I'm analyzing the market with this what we call the eagle eye view. This is very common between experts, and I encourage you, even if it's not your thing, if you are not using position trading or long-term trading, you have to have this eagle eye view. I have a lot of experienced trader friends who are using 1 minute chart, but they have to have this eagle eye view strategy. What's the meaning of this? It means you start from the big picture, okay? The big picture. This is the 1 month chart, meaning each candle of this chart represent 1 month, okay? So this means that here we are seeing maybe years worth of data, okay? This is like starting from 2019 when the gold were around $1,300 per ounce, okay? Today we are trading almost $2,365, and actually gold is going down for the last 4 days. But let's see, this is the 1 month chart. So this candle, actually the March of July candle, it's opened on the $2,324 per ounce. Now we trade on the 2,364 per ounce. So actually the 1 month candle is green. Here, this means it's an up candle. The market has gone up from the 1st of July until now. So we now know that we are technically on the long term. We are in a very strong uptrend. Let's go weekly. You see, still we have this uptrend, but you can see that this week it's red, okay? It was here and gone here. So it was open this week around $2,411 per ounce, and now it dropped to $2,300, $63 per ounce. So this week we have this red candle, but still the bigger trend is going up. So we go to the daily, we see that today this is a very big move to the downside. Actually, maybe it didn't go for maybe a few dollars above the opening price, which was 2,398. So the highest was like $1 above this. This is a very big down move. Of course, this was because of the American news that came on 4:30 Dubai time, which encouraged the movement of the US dollar against gold. Okay, so this is a down candle, and before maybe there is like 8 down candles. So now you can see that the very long term is going up, the short term in the daily is going down. So when we go to the 4 hours, we see it's going down. Hourly chart is going down. So even the 30 minutes chart. Now, if I'm going to have a trade with this strategy, what I'm going to do? For me, as like, let's say in an example, I'm like position trader. I want to take long-term position. I shouldn't take a short position in this scenario. I shouldn't sell gold, even if it's going down daily, but I shouldn't, because the long-term, the weekly and the monthly is a very strong uptrend. But this has to have, you know, a very big stop loss. So for example, I can have a buying position from here and make the stop loss like at this level, which will be around here. Okay, but most of you, I think, are very short-term traders, so you can have the sell trades. You can even go to the 15-minute chart analysis. Okay, we are now breaking this support, so I can have selling position, short position from here. I can make my stop loss above the 2,381. This is $20 stop loss. So if the position is like standard position, like 1, this will be like $2,000 stop loss. If it's many lot, like 0.1, this to be $200 stop loss, and this may be in my risk tolerance, so I can sell gold from here. Let's sell it, and I have the stop loss in the area we determined around 80, 2,380. Actually make it above a little, because this is the last resistance area, so around 32,384. Okay, this might be my stop loss, and my take profit should be at least 1-to-1. So I should aim to around $2,340. This should be my take profit. Should be like this. Okay, this is now a 1-to-1 trade for the same amount I am risking, I am trying to gain, or I'm willing to gain. Okay, this is a good trade for this amount and the risk tolerance I have. Now I can have, for me, pre-decide decision that if the market moved like $5 in my favor, so it went around 2,357, I will move my stop loss to the entry point to guarantee it's what we call a zero risk trade, a break-even trade. So I will never lose, even if the market reversed on me. I can do like this. This is a pre-decided order in my mind before the market move. I can do a trailing stop, but I don't encourage to do this, because in this situation it will move directly to the entry point. Or I'm decided to do it myself. This is an example. Okay, so I can decide also to leave the market. I do not want to watch it while it's doing this, and I will not open other trades, because this is already having a big percentage of my amount, and I will not risk more than this in any other trades. So this is an example of how to trade. Actually, we have some also fundamental analysis before that the dollar has this news that encouraging the strength of a dollar. So also I have some fundamental analysis beside this. You can see that actually the trade started to have some profit. Maybe we can, if you are like scalping in 1 minute chart, you can have this as a good trade, and you can close it even. Some scalping traders is just willing to get $1 or $2 off the gold move, and they are good with it. Okay, so this is the Quick example, let's see on the trading plan. I just don't want to take more of your time. If there is any more question, I think we are good to go. So please follow us on our social media. Also, we always have this webinar in a weekly basis each Thursday on 6 p.m. And if you have any question, feel free to communicate with us on our website. We have all the information to communicate with us, and also you will receive an email with all this webinar information. If there is no more question, okay, I think that will be it. Thank you a lot for your time, and I wish to meet you soon in the coming webinars. Always be on us, and thank you. I will end this now. Okay, goodbye.